Welcome back, ladies and gentlemen. Okay, this is the A-Star Investor Mentorship. In this mentorship, you will learn how to read the price charts like a professional. And in this particular volume and module, you will learn about liquidity, candlesticks, and the different market phases. So at the end of this lesson, you should have a very strong understanding of what liquidity is, of how to read candlesticks on a price chart, and how to map out the different phases that the market could possibly be in. So let's get it. So the first thing you talk about when you think of price charts, when you think of reading price, the first thing that comes to your mind is liquidity. Liquidity is indeed the market bloodline. Imagine the market was a human being and the market's name was Joseph. Now, just like you and I, Joseph would have eyes to see, a mouth to eat, to taste, tongue, nose and skin, and all those different organs that all function together. But without blood in his veins, Joseph would not be alive. Likewise, without liquidity in the market, price action wouldn't happen. So what is liquidity? Liquidity is indeed the ease at which an asset can be exchanged for cash. So you have $500 and you want to buy an asset. You have to exchange your $500. You gotta give your $500 to somebody who is going to sell you whatever asset, whatever stock or currency it is you're trying to buy. The ability for that to happen, that is what liquidity is. For there to be somebody willing to exchange cash for your assets, or somebody willing to exchange an asset for your cash. Why this is important is because for a transaction to be complete, when you want to buy something in the market, for that transaction to be complete, somebody else needs to take the other side of that trade. Somebody else has to sell that same asset to you, right? Just like when you go to a store, you want to buy groceries, the grocery store has to sell the assets to you. Same thing in the market. So liquidity is a key component in the market efficiency program. We're going to move fast, guys, so I need you to pull out your notes and take notes, because you're going to need to study these things on the charts. And I promise you, these tools, these concepts, they are solid. This is the market indeed. So look at this price chart, right? This price chart is the chart of a stock called Chewy. Chewy, the company, they make dog food and other pet-related products. Their ticker symbol is CHWY, and this is the weekly chart. Now, this chart, you as a beginner, this may not make a lot of sense to you. You might just see a bunch of boxes on your screen moving up and down with no significant meaning. I guarantee you 100%. And if you do not believe this, at the end of this mentorship, you can apply for a refund. But these concepts is the market. At the end of this mentorship, you should come back to this chart and look at it. And it would be like you just put on glasses and you're seeing through a whole new lens. And all of this will make sense to you. And you will indeed be able to read price action for yourself and start taking trades that can make meaningful profits and change your life. So the market efficiency program. What is the market efficiency program? It's a paradigm, right? It's a way of thinking. And this way of thinking is shared by the institutional traders. It's a mental resource. And the market efficiency program is a concept, and this is it. Firstly, we know that there's big financial groups. Those are the participants behind price action. That chart I just showed you, the chart of Chewy, the pet company. Have you ever asked yourself, like, what made this move happen? Like, what made price go up this bottom to the top? What made price move all the way from this top to this bottom right here? So There's people, human beings just like you and I, who are behind that move. And those people are the big financial groups. I call them the BFGs. Now, the BFG's intention, when they come into the market, is to make themselves richer. They want to put more money into their pockets. That is why they do this. That is why they show up to Wall Street every day, Monday through Friday. Because they want to enrich themselves. Greed drives the market. So, there's only two ways of, making money in the market. There's only two ways of getting richer in the market. It's either you buy long, take a long position, which is when you buy an asset with the intention of selling it at a higher price for a profit. Or the other way to make money, and the only other way to make money, is by shorting the market. When you sell short, you're essentially borrowing a stock from your broker to sell because you think the market is going to go down. So when you sell it, you get cash. That cash, you're going to later use that cash to buy back that same asset, but now you're going to buy it back at a cheaper price. When you buy it back at a cheaper price, you got some cash left over in your pocket, and you can now return back the stock that you borrowed to your broker. That whole borrowing process happens electronically and in seconds, so don't worry about it. And then the other thing to note about the market efficiency program is that the BFGs, the big financial groups, when they trade, these banks, the likes of Citibank, Bank of America, Wells Fargo, institutions, investment banks, pension funds, hedge funds, and those sorts of big financial vehicles, when they trade the markets, they trade with billions and trillions of dollars on a day-to-day basis. The volume of money is so large injected into the market. The volume of all their orders is so large injected into the market. That creates liquidity. Because an investment bank wants to buy 10 million shares of the stock I showed you earlier, Chewy, now there's 10 million buy orders in the market. So anybody who wants to sell Chewy stock can easily pair their sell orders with one of the 10 million buy orders that the institution has just put into the market. So you see how these BFGs inject liquidity into the market. They make it possible for you to exchange your cash for the asset or asset for cash. Now, rewatch that verse I just said, and take notes. Listen to it until you understand it and internalize it. And from here, I want to go into the concept of order pairing. Right. So we know that these big financial groups have so much money coming into the market. And the market makers also know this. The market makers are the people who make the market. They're the ones who quote prices. When you see the price changing on your screen, the people who are in charge of quoting that price and determining the lowest offers and the highest bidders, that is the market maker. They are the middleman. And they know that the BFGs want to make money. Now, the market maker's job is to satisfy the desires of their clients. Their clients are not you and I, although we are in the market. But our size in terms of volume of money we put into the market is so little. It is virtually like a drop of water in a pool. So the clients that the market makers are concerned about fulfilling their desires are the institutions, the BFGs. So the market makers, from their own point of view, because now we're talking about the market efficiency program. These market makers, they know that the institutions want to buy or sell the market, and they have large amounts of money. Now, the problem is that you cannot just hit the market with 10 million buy orders. Remember what I told you about the liquidity? A transaction takes two people to complete it. It takes a buyer and a seller. If I have too many buy orders and there's nobody willing to sell to me, I can't buy the market. So that's the problem with the institutions that they are facing, is that they have so much money that they can't just enter the market at any time. You and I, we can open our app right now and place a buy order or sell order because we have the amount of money in our capital is not large enough to cause prices to move. But these BFGs, their volume into the market is. So they can't just get into the market anytime. So now you need to know this. The market makers have a tool called the IPDA. The IPDA is an algorithm. Write this down in your notes. The IPDA is an algorithm. It stands for the Interbank Price Delivery Algorithm. The Interbank Price Delivery Algorithm. And what that algorithm does is that it is going to deliver price to areas on the chart where there is enough liquidity for those BFGs to pay their orders. So the institution wants to buy 10 million shares. But like I said, it cannot just get into the market anytime. The institutions can't just hit the market at any time. So the algorithm is going to deliver price to an area on the chart where there is enough sell orders to pair with all the 10 million buy orders that the institution wants to put into the market. This is how the market works, guys. Like, I've literally just offloaded a dime, a gem right now. This is the algorithm, and this is what it does. And as we go deeper into this mentorship, I will show you with empirical evidence that it is indeed an algorithm that delivers price. It is not people, it's not a matter of buying pressure, selling pressure. It is a matter of liquidity pools and an algorithm having to deliver price to those liquidity pools. And this cycle just repeats itself over and over and over again.